Hello, everyone, and welcome to your Glassnode Onchain report for week 33, 2022. Now, we're going to spend some time with the HODL waves and the realized cap HODL waves today, which are two very, very powerful sets of metrics. I use them all the time. And what we're really trying to assess is the flow of funds, the changing wealth distribution of the Bitcoin network. And why this matters is because we have these phases of bull markets where you have people who come in for the speculation and the hype, and it's fairly what you would call hot money. And then you have periods of bear markets where it's the stronger hands, the higher conviction, the hodlers. And over these cycles, there's a transfer of wealth between them. And the hodl waves are a really powerful tool to visualize these effects. So as I mentioned, we've had this kind of reshuffling of the ownership structure. And this is an important part of bear markets. This is why they take time, because eventually those coins will find a hodler who will take them off the market. And what we saw through the course of May and June was two significant capitulation events. We saw the lunar event, and then we also saw that final flush out that went down below the 20,000 all-time high of 2017. Now, again, that doesn't mean that that's the final flush out. We can see these things like March 2020 was kind of a flush out that came almost a year after, or actually more than a year later, after we had the flush out in November 2018. So these things still take time to digest. But now that the dust has settled a little bit, we can take a bit of a look at the playing field and see where those coins came from, where they went, and what is the current state of play. So we're going to look at this macro trend of coin maturity. We're going to throw in there a view of long and short-term holders, just to give it a bit of a bit of descriptive terminology and some probabilities and statistics. And then we'll also look at this at the ultimate thing we're trying to look at is the change in distribution of wealth. And we look at this from two different lenses. The BTC denomination, how many coins each age band holds, and the USD element, which is how much they invested based on when the coin last moved. So we'll talk about that distinction as we go. So as usual, please do give us a rate, a share, and a subscribe. It does help get this channel around to more people and try and just explore how we can use these tools to really better understand what's going on under the hood. So here we are in our week 33 dashboard, which you will find in the video description below. So what we're looking at here in this first metric is one of the really big picture cyclical metrics, percent of supply last active 1 year. So we're looking at the coins that are older than 1 year here. So it's basically looking at how much of the circulating supply as a percentage is older than 1 year and hasn't been spent in that time. And you can see that we go through these large dips into the bear, then that starts to recover. Approximately a year after the top starts to get put in, we start getting a recovery back to the upside. And you can see that this process takes time. These are coins maturing. They're getting older. They're moving through that process of hodlers who've actually put them into cold storage. Obviously, through this process, you can see that there's dips, there's phases where people spend, and obviously even during an uptrend or a downtrend, there's coins going into and out of 1 year. So it's a dynamic system, but you can see that surprisingly, we actually get these quite smooth transitions. It's showing a macro behavioral shift. And really, this is what I look for, is these big picture shifts, set the tone, and then you can use things like the HODL waves to go into much, much finer detail. So on a very, very big picture, here we are on a relatively steep ascent on our supply last active 1 year. This is indicative of hodling behavior that's going on. Hodling dominates. There's more holding on than there is spending. You can see that really since we got to this peak here before our final sellout down here to in June, we've more or less traded sideways on this metric. So this is showing that there's two things. There's either a slowdown in the number of coins that are migrating across the boundary, and we'll talk about that in a second. There's also the potential that it's just kind of reached this equilibrium point where there's a bit of spending going on, but there's also a little bit of saving going on. So there's kind of an equal balance either way. But if we think about this, we're talking about supply last active 1 year. 1 year ago, if we're sitting at the top of this is in June, that's back here at the very, very bottom. We had our major sell-off here in May 2021. Then we had a period of about 2.5, 3 months where we were consolidating but trending down. It was pretty scary times for those of you who were there. And that puts us in the middle here. Now, what we saw is that during this rally, when we got this momentum back up towards the upside in August, we saw that there was a large amount of outflows that came out at that time from exchanges. And here they are showing up 1 year later. So we can see how these coins kind of migrate through the supply stack over time. So that's our general cyclical behavior. We're more or less trending sideways on a semi-macro scale, and now we're going to dig down and explore that in a little bit more detail. So we're going to start off here with our HODL wave. So this is looking at BTC denominated wealth, the percentage of supply, of circulating supply that's in these different age buckets. And we're looking at this from a 6-month to a 3-year basis. So really what we're looking at here is coins that have been hodled for a reasonably significant amount of time. 6 months, they've seen some chaos. And 3 years, generally speaking, when they're beyond 3 years, I personally classify them as almost ancient coins. They've been held for so long that their cost basis has become irrelevant. So the holder, they're here for the long term. And they're also a very, very small percentage of the overall spending. So we're looking at kind of the meat of people who bought during this cycle and are still holding on. So it's a fairly high conviction cohort. And what we can see is that from the bottom here, this is where we had our low in our percent supply 1 year. We have seen about a 10% supply boost where that cohort has consumed and then hodled 10% of the supply. And we can see this in the HODL waves. This yellow band in the middle here is our 1 year to 2 year band. And note how it swells out over time. This is that process of coins entering that coin age band over time. It swells out and becomes a larger and larger proportion. Now, you can see here that this has been going on for some time now. Really, this started in November, right near the all-time high. This really started swelling out. So the next thing to pay attention to is that when we get to November, because the top band up here is 2 to 3 years, when we get to November this year, which amazingly is actually not that far away now, this will start swelling, assuming they don't spend, will start swelling into the 2-year band. Now note this band down the bottom here. This is the 6 months to 1 year. It went through that swelling. And then at the exact same time that it starts descending, those coins are migrating up into the higher age bracket. We're seeing coins going across that 6 months to 6 month and 1 day boundary, which puts them into the next age band. So you can see how the swelling of this band became the swelling of this band. And it will happen when the coins go across that boundary. And this is how you can see that gradual climbing of coins through the different age buckets. Now we're looking at the realized cap HODL waves. This is the same age bands, except instead of looking at it in terms of how much of the BTC circulating supply are in those buckets, here we're looking at how much wealth, USD denominated wealth they hold. So the way to think about HODL waves, the standard version is BTC denominated wealth. You will see that Satoshi's coins and the 10-year-old plus are a fairly significant chunk. They're a purple band and they're quite large. But they have no price. When they were last mined and when they were moved, they had no price, those early miners. So their USD value, the economic weight of them, is actually near zero. Whereas when we look at coins during our recent cycle, you can see here that up in the HODL waves, they represent 37% of BTC supply. But they represent 63% of the USD invested wealth. So you can see that this is a very, very big difference. We have a huge amount more USD wealth because Bitcoin is worth more, and this is where all the trading activity happens. So what we generally see is that at the front end of the curve in recent history, that's where a lot of the wealth has been injected, has been taken out. It's where the trading's going on, the coins are changing hands. Generally speaking, the realized cap HODL waves are like an amplified version of the HODL waves that discounts old coins and puts more emphasis on new ones within our recent cycle. So that's one way to conceptualize this. But we can more or less see a very similar effect. This has actually jumped from at the bottom here in May 2021. We had 11% of the USD wealth was in these coins, aged 6 months to 3 years. So this is after a big period of distribution. They sold their coins, they distributed that wealth, and that became very, very hot money. It went from 1 year and 2 year to 1 week, a brand new buyer who bought the top. But a huge amount of these buyers accumulated and hodled on. Now, this includes everyone from HODLers who were buying the lows, some HODLers who bought the top. There'll be some speculators who bought the top and became HODLers. There's also a couple of institutions and the Michael Saylors of the world in there. So it's a really, really mixed bag of people who actually cause this to really climb. But you can see that a huge amount of the wealth is currently held by people who we could arguably consider to be the smart money. They're people who are sticking around even through all this price chart, everything you can see here, all of this chaos, they hodled on. So it's a very, very interesting dynamic, and we have a large amount of that wealth migrating up the stack towards those older hands, and they just simply aren't selling. And that's a signal of conviction. Now, the RHODL ratio is a really, really great oscillator. It's actually one of my favorites because it's such an elegant construction. That realized cap HODL wave that we were just looking at, imagine you've got the 1 week old coins. They're fairly hot, right? They move around a lot. They're really speculative, and they can only be 1 week or younger than that when someone who had a coin that was older than that spends it. So it must go from an older bracket down into the younger bracket. Conversely, during a bear market, we see that transition of wealth back to the smart money. There's more 1-year-old coins, 1 to 2-year-old coins. So the RHODL ratio is a ratio between, at very, very high peaks, it means there's a huge amount of hot money. Lots of old coins have been spent, so the denominator gets very small, and you also have a lot going into the numerator of this ratio, which is the 1-week-old coins. So you get this massive, massive peak where there's the largest amount of hot money in the system. You can see that it gets very, very hot, and it normally happens quite quickly. You get these large bursts, but also note that the rate of change, how quickly, 2013, it slowed down a bit in 2017, it slowed down a bit even more. We're starting to see this almost diminishing return profile. Things are getting a little bit slower over time, and they take a lot longer to play out. But nevertheless, we still have this transition of wealth from smart money, from people who buy near the bottom, up towards hot money at the top. Now, interestingly, we didn't have a blow-off peak in our current cycle. We actually had this kind of flat top. So you can actually see that this particular metric was signaling a very, very different market structure. Same concept, but different structure. So you could argue that when we came up to this previous all-time high, we had the same amount of hot money in the system as we did at the previous peak, which also wasn't to break higher. So you could argue that this is potentially a bearish divergence here, where it's basically signaling that we really didn't have that. We didn't have a push or an amount of hodling going on to really push this thing up to new heights. But where we are at the moment, you can see that we've essentially reset that. We have seen a transfer of wealth from the hot money back to the smart money. This is reflecting that expansion of that 1 to 2 year style behavior. We're seeing more of those hodlers coming in and actually sitting tight and holding onto their coin. So it is signifying that we are getting close to that reset zone where we actually have a maximum zone of hodlers and a minimum zone of speculators, which is generally what bear markets tend to go through. That is that ownership structure shuffling. We've seen it in the HODL waves, we've seen it in the realized cap HODL waves, and here we can visualize it within an oscillator. Now, bring it onto the short and the long-term holders. Let me start with just explaining that the circulating supply is a combination of 3 factors: short-term, long-term, and exchange balances. Those 3 combined, short-term holders are less than 155 days. The reason we use that, by the way, is that statistically speaking, a coin that's been held for 155 days is less likely to be spent. It's very, very unlikely on any day that that coin is going to get spent once it crosses that 155 threshold. So there's a statistical probability that we've done, and there is a study that we've produced, which is in the description below. So we've got short-term holders, which generally you can think of as the hot money, the speculators. There's more, the coins have moved recently, and they're thus more likely to be spent in the face of any new volatility. Our long-term holders, on the other hand, are those that have crossed that threshold. And as we saw with that supply above, we were looking about 6 months. So 155 days at 5 months is actually not too far from the truth. So we're looking at a similar cohort of people who've held their coins long enough that they're probably not going anywhere just yet. And then we also have exchanges. So long and short-term hold supply are only coins that are not on exchanges that we're tracking. And then we have the exchange supply that builds up that third and final component. Now we're going to explore those 3 components momentarily. So starting with the long-term holder supply, you can see a very, very similar pattern to our supply greater than 1 year, albeit it is going to react faster because it's 5 months versus 1 year. So we do start to see this climbing a couple of months earlier than the supply last active 1 year. But very, very similarly, look how it's basically been trading sideways on a macro scale, really since the all-time high. It's been going more or less sideways. Now, I want to actually zoom in on just this behavior, noting that on this particular view, we're looking at it in the scale of things. It is sideways. But note how when you zoom in, you can actually see it's quite volatile. We go through periods of distribution, periods of hodling, periods of distribution, hodling. And during our recent, this is really what we care about, right? The last couple of months. What happened in the last couple of months? Well, we had our lunar collapse here, and then we also had our sell-off below the 20,000 all-time high. So what we have is a accumulation period, and then lunar spooked them out. And then we had our sell-off down below the 2017 all-time high, and that spooked them out even more. And they've been going through a bit of profit and distribution. See how it's getting more volatile? Long-term holders are being flushed out. They are spending. But simultaneously, if we go back 155 days, similar to our HODL waves, where is that? That's actually in this pre-lunar period of accumulation. I might actually just zoom out to 1 year so we can see this on a little bit more detail. This zone here, here's our all-time high. This is that consolidation phase that we're in for about 3 months. There was a lot of accumulation that happened during this period. We talked about this in some of the week on chains back then. Huge amount of accumulation. Now, those coins are all in the process. This thing is currently halfway through this, currently in the process of migrating into long-term holder supply. So think about that like there's a torrent of water that really wants to rush into long-term holder supply. When we get these down periods, it's because the spending is overwhelming that incoming flow. But that incoming flow doesn't stop because this was a very long period of lots and lots of buyers. So note that as soon as the spending stops, this thing starts ripping higher again. That's that natural incoming flow. So there are people who are still holding their coins from up here and just simply are not spending. But there are also long-term holders who are spending and are capitulating as this thing continues to flush out. So we get these violent downshifts and then we get this violent reversion back to the upside. So there's two competing forces here that are going on. And this is why you can actually have a long-term holder flush out at the same time as the overall supply trends sideways, because under the surface, there's both spending and maturing going on at the same time. And these two forces are counteracting each other. Now, the next component is the exchange supply. So again, let's really zoom in on our recent history. We care about the last couple of months. We can see that back here in May 2021, this was a huge period of inflow. People panicked, they sold, they sent their coins to exchange, get me out of this thing. Well, here we are having a significant, this is a 75% downturn. And note how it's mostly red. These are outflows. This is actually quite significant in scale. This is as big as it was pre-bull. This is enormous outflows. There is demand even down here at these lows. And note that this actually persists even in recent weeks. So whilst we have long-term holders that are spending quite significantly, this is a non-trivial drop. Note how the overall, we're still seeing outflows. So with those two components, long-term holder supply, we can argue is down. So there's some spending going on. Also sideways on a macro scale. Exchange supply is just down. We are seeing coins flowing out of exchanges. And because it's a component thing, we've got long-term plus short-term. Both of those are descending. So those coins must be going into short-term holder supply. So now this is our looking at the balance here. We've got our long-term holder supply at the top, which on a macro scale you can see is sideways. Exchange reserves are to the downside. And then you can see in red that our short-term holder supply is on the way up. So what we're actually seeing here is that those coins are migrating into that short-term supply. And note in this recent history, this significant jump. This is what we're going to zoom in on and double click on right now. So short-term holder supply has been on the way up, and we have seen a significant boost into that recently. And what we're basically seeing here is that long-term holder flush out. They are sending coins to exchange. It's not all of them. It's a subset of them because overall it's macro sideways. So we're talking about a small portion of long-term holders, but nevertheless, there's a sufficient number that it impacted it over the microcosm, the small space. So we are seeing long-term holders flushed out, but we're also seeing those coins coming out of exchanges. So the long-terms are going in, but then someone's buying those coins and even more to make sure that exchange supplies are going down. And note how following the 20,000 sell-off, right, in June, we saw that we had an enormous amount of coins flowing into short-term holders at the lows. So what's going on? These are people who stepped in and bought that low. These are people who saw the price trade below 20,000, and whilst they're short-term holders now, that's because they've accumulated coins within the last 155 days. But imagine the conviction you need to step in when the price is waterfalling down below $20,000 and start withdrawing. These people are quite significant. And after such a long bear market, especially if you agree with me, where I think it really started back in May 2021, after such a volatile and challenging period, down 75%, the folks who are stepping in and buying these coins are likely to actually be those long-term holders, those same high conviction hodlers, because they're stepping in down at these lows despite all of the chaos that's around us. So again, it's just kind of really demonstrating how we can pick apart and observe these different cohorts and their behavior patterns to really assess who was doing the spending, what was their magnitude, And what's the net result in the changing ownership structure? So these guys, the reason why these guys matter is their cost basis is down at 20,000. They are in a much, much more stable financial position. Now, obviously, if price falls, then that comes back into question. That's how now we at least know there's a whole bunch of people with a cost basis down here, and that could provide support. And it may also be a significant sell side if we break down below it, because people are going to go, oh man, it's not over yet. Get me out of this thing. So we can use this to frame up our probabilities. But we do know that there's a significant amount of supply that got accumulated by these folks down at lower levels. So they're in a better financial position and they're under less stress at the moment, which is generally quite constructive. And the very, very last thing I want to touch on is coming back to the HODL waves. Remember, standard HODL waves are BTC denominated, whereas our realized cap HODL waves are USD denominated. So I want to explore an interesting divergence that we have just to give you an extra little bit of framing of this thing. Now, note that generally speaking, we see these upticks. These are hot coins. These are coins that are under 3 months, quite young. Generally speaking, they represent speculative money. Now, on a BTC basis, note that they generally climb quite significantly during bulls. This is that transfer of wealth. The old money, the smart money is selling. New people are coming in and buying those coins. But also note that we get these big spikes down here at the lows. These big spikes when we have these capitulation style events. This March 2020, this big spike. This is a capitulation. It's a short, sharp event where people just panic and just flush out their coins. They go into those younger coin bands. They've come out of the older coin bands. People panic sold, and then we wait for the dust to settle. We had one here as we kind of sold up. This was in December. We had this first flush out, and then we had a bit of an uptick. This is actually a multifaceted. This took months. There was a process of both the lunar sell-off, then the June sell-off. This was a really, really, almost like an elongated capitulation event. But we did have that uptick in these young coins on a BTC basis. But on a USD basis, look how this continues to descend. We didn't quite get the same uptick. These upticks typically happen only during bulls because coins are getting revalued from cheap prices. The guy down here who bought his coins at $4,000 revalued them at $40,000, a 10x profit, but the wealth that he was holding was small, back here, 4,000. But the wealth he's holding or transferred to someone else is much, much bigger up here. Note how we don't really see, here's March 2020, we don't really see these capitulation events show up. That's because we're seeing coins revalued from $50,000 to 20. It's going the exact opposite direction. We're seeing that the wealth is not being transferred. We're actually seeing an expulsion of wealth from the system. The guy who invested 40,000 is only getting 20,000 for it. So we're seeing that wealth is actually much, much smaller. It's the exact opposite. So in this instance, we actually have to use the standard HODL waves on a BTC basis to try and confirm this. But we can also see that capitulations typically don't show up on the realized cap HODL waves, but they do show up on the BTC denominated ones. So thanks for tuning in for that session, folks. Hopefully that was a bit of a snapshot of how we can use the HODL waves in particular to try and isolate different phenomena. We're looking at coins maturing across different age bands. We're also looking at coins that are younger than a certain age band and what that means in terms of the USD and the BTC wealth. So the RHODL ratio is the metric of the week, and it's really because it kind of distills all that information down into a single metric where you can basically see this oscillatory behavior. And as you saw, you can combine that with many other metrics to get a real view of what's going on in the space. Anyway, hopefully you found that useful, and I will see you in the next one. Cheers.